Good morning and welcome APL shareholders to this webinar to update you on the company's results for the first half of financial year 2020. My name is Andrew Findlay and I'm both the Director of APL as well as the Managing Director of Antipodes Partners, the manager of APL's investment portfolio. I'm joined by Jacob Mitchell, CIO of the manager, who will provide a portfolio update, which I'm sure you'll find of interest given the heightened volatility in markets over recent times. You can view the slides on your screen during the webinar. The slides are also available on our website at antipodespartners.com/APL or via the ASX release. Okay, given we've got 30 minutes and want to leave sufficient time for your questions, let's get straight to it by summarising the company's results as announced to the market last week. For the half year ended 31 December 2019, APL recorded an operating profit of $12.1 million. The two key issues to discuss, of course, from a company point of view are the interim dividend and the discount to NTA. In terms of the dividend, the board resolved to pay an interim dividend of 2 cents a share, which is consistent with the dividend paid for the prior corresponding period. As at yesterday's closing price of 95 cents a share, this 2 cent dividend equates to a dividend yield of 4.7% or 5.6% grossed up for franking credits, which is a strong level of income for a global equity portfolio. Note that the dividend will be franked to 50%. And as mentioned previously, franking credits are primarily generated when the company pays tax upon our realised gains from the investment portfolio. So as the company matures and more gains are realised, shareholders can therefore reasonably expect the level of franking to increase over time. The company's DRP will be operative for this dividend payment, and at this stage around 650 shareholders, or approximately 8% of the shareholder base, have elected to participate. The closing date for DRP elections is next Monday, and please check the link on our website or call the company's share registry boardroom if you need any assistance with this. Note the DRP is very shareholder friendly in that should the company's shares be trading at a discount to NTA, then shares will be acquired on market to satisfy the DRP. In other words, they're not new shares being issued and hence the DRP is not dilutionary. While the NTA appreciated over the half year, it lagged the benchmark primarily due to the conservative net equity exposure of the company's portfolio in a strongly rising market, as well as the value style bias of the portfolio. Note that this performance relative to benchmark is one measure of performance. Shareholders are obviously also concerned about absolute returns, capital preservation and volatility. And a conservative net exposure is precisely what protects the portfolio in down markets. And we've seen the benefits of this during the sharp market falls experienced in February when APL's portfolio outperformed by around 4%. This is the reason many shareholders are given for holding APL shares. We're pleased that the portfolio is performing as we'd all hope in markets such as the current one. We'll hear more about the portfolio from Jacob in a moment. If we look at the movement in NTA over the half year, you can see the material drivers have been a positive portfolio performance and the payment of a final dividend in October 2019. Also note the small but positive accretion due to the buyback that commenced during the period. This positive impact on the NTA will continue as more shares are bought back. In round numbers, should we execute the full buyback under the current authority and the planned additional authority, this would equate to 20% of shares on issue, and if we buy them back at an average of, say, 10% discount, this would lead to a 2% accretion to NTA per share. In terms of dividends, this slide highlights the key dates for the dividend payment and places it in context with the prior dividends. Please note the ex-date is today. Now let's turn to the matter of the current discount to NTA. This is the board's number one issue and we know it is for many shareholders too. The company remains committed to addressing the discount to NTA, noting however that APL is not in a unique position and the majority of ASX global equity LICs are currently trading at material discounts as can be seen on this slide. In fact, APL's discount is in line with the average discount for its global equity peers. To address the discount, the company has implemented a number of initiatives, including undertaking one of the largest on-market share buybacks of any ASX-listed LIC. The initial buyback authority from July last year applied to up to 10% of the company's shares. Since then, the company has more than doubled the daily volume of the on-market buyback and continues with an accelerated buyback within this current authority. So far, around 30 million shares have been repurchased, leaving around 24 million shares remaining. And using the current buyback rate of approximately 400,000 shares per day, we estimate the current buyback authority will be fully utilised by the end of May. I should also point out that the directors of APL, the manager itself and its executives collectively owned in excess of 8 million shares in APL as at the end of last year, so 31st of December 2019. This is a very significant holding, making us a top 10 shareholder and creates a clear alignment with all shareholders. We've also moved to daily NTA releases, which makes us one of the only LICs to do so. We think this really helps shareholders to know what the portfolio is worth on a timely basis, with the aim of improving our transparency. I acknowledge that we accept room for improvement in shareholder communication. We're very actively stepping this up and are confident that these efforts, which will take time, will ultimately bear fruit. In the company's view, the present discount to NTA represents an attractive buying opportunity, and I note that the company has meaningfully stepped up the daily volume of the buyback, and a number of directors, including myself, have recently acquired additional APL shares, as highlighted in recent company releases. In light of the progress with the current buyback, the board has decided to hold an EGM on 21st of April this year to approve an increase in the existing buyback authority by a further 10% of the shares on issue. Further details of the EGM will be communicated to shareholders over the next few weeks. The board continues to actively monitor other initiatives to address the discount to NTA. We've received a number of questions and suggestions in this regard, and I'll address these specifically in the Q&A. At this point, I'll hand over to Jacob to take us through the portfolio update. And over to you, Jacob. Very interesting times.
Thanks, Andrew, and welcome everyone today. As Andrew referred to, 2019, from a performance perspective, we lagged a very strong bull market driven by the US and by growth stocks, led by growth stocks. When you look at our winners over that period of time, a number of our companies were subject to takeover. That was Line and Tiffany. And then, not surprising, the others are seen as more Alibaba, Sony, Samsung. They're in that sort of techie, growthy space. We think they're interesting longer-term holdings. And when you look at the laggards on the long book, it has hurt us not having exposure to some of the mega cap tech platform stocks. And I'll go through some of our rationale for not having that exposure, or taking that exposure in companies like Microsoft instead of Apple. And then in the most recent period, calendar year to date, we've had a good turnaround in our long-term holding in EDF and a more recent acquisition, Uber. Obviously, the gold stocks and some of the shorts contributed in this period of volatility. And then the bottom five, they are punctuated by more traditional value type exposures. They are, we think, longer term, our holdings in strong retail banks, will turn around in the course of time. Looking at the outlook for markets, I'll go through each of these bullet points very quickly, but we think, we are in an environment where investors are very cautious about value traps. I think over the next couple of years, there's going to be increasing numbers of, because of the duration bubble, investors chasing long duration assets with the collapse in real yields. Increasingly, there will be growth and profitability traps as well as value traps. Coronavirus is going to force policy responses. Similar to, as you've seen last night, you will have these sort of violent relief rallies. Central banks, though, I think will increasingly, as rates approach zero, there will be a lot of questioning as to what central banks can really do outside of their governments leading with fiscal policy, which leads us to who has the firepower and then how will that firepower be used. Decarbonisation may be, the beginning of a major investment cycle. So what's our evidence that investors are herding into long duration assets? It's really just looking at how, let's call it valuation dispersion, how extreme are the top quintile on a sector neutral basis. So very importantly, this isn't distorted by one sector. We're taking out sector distortion and we're saying, how are the top quintile of highest PE stocks? What is that multiple versus the lowest quintile? You're at a 2 standard deviation extreme event, which is not far off the 2000 tech bubble high. Turning to our next slide on 15, you can see this in factor performance. Year to date, it's interesting, we have been able to deliver some alpha when, you've had this extreme underperformance of low multiple stocks. I mean, we thought 2019 was a bad year for low multiple stocks. Well, the beginning of 2020 became a nightmare. Now, you can see a 9.3% down year, whereas, profitability growth and much more moderate outcomes. And when you look at the long-term performance spread of those factors, you can see, and if you look at the heat map, the question would be, if a particular style of company continues to outperform over a very, very long period of time, if its earnings are not growing in line with its share price, it's clearly becoming more expensive. And you can see it very clearly on the heat map when we're looking at 30 years of data. You're seeing a 2 standard deviation spread between the valuation of high growth, high profitability stocks versus low multiple stocks. Turning to our next slide, you can also see it in profit shares. We're looking at US non-financial EBITDA margin. And, I think this is, one of the reasons why we have an underweight to the US outside of the large cap multinationals in the US. We do have an underweight to more domestically exposed companies. They are not really performing. The yellow line there shows the EBITDA pressure that they're under. So we would argue QE, that the reality of making money very, very cheap, has benefited a few companies who, through their business models, have been able to take the large tech platform companies, Google, Facebook, Microsoft, are taking a larger and larger share of the corporate profit pool to the detriment of the rest of the corporates. That pressure will continue. And it's a bit of a toxic mix when you consider the boom in private equity and the boom in the high yield or leveraged loan markets, who are funding many of those weaker companies. So what do we think about coronavirus? We have put an update on the website, a more detailed update, but just very briefly, you can see on the top chart on slide 17, the infection rate in China has definitely tapered off, but it's still accelerating in the rest of the world. And we have to prepare ourselves as big countries like the US increase their testing, that the infection rate will continue to go, detection will go up. And there will be, I think, consumers will tend to become more defensive. So I wouldn't be surprised if we have a sort of a technical recession, and bond market, bond yields, the 10-year bond yield in the US at 1% is clearly pricing in a very low growth environment, and credit spreads are starting to have widened by approximately 100 points. This is just a measure of the CDX index on high yield is a measure of the default probability of a collection of high yield bonds. So you can see that spread has gone up about 100 points. How do policymakers respond? Well, we've seen the Fed cut. We've had the first, we've had a few, central banks are cutting around the world. We are loosening policy. We went into this, let's call it psychological hit healthcare crisis with an industrial cycle that was really already very fragile and only just showing some minor green shoots. So we already had stimulus coming, and now we will see it accelerate. But it needs to be complemented by direct fiscal policy. And I think it's just keeping an eye on how that is targeted, what form does it take. We think in China it will come with a 5G wrapper, i.e. Chinese consumers will be encouraged to upgrade their phone service. In China and Europe, it will also probably come in let's call it a decarbonisation wrapper. Subsidies to upgrade cash for clunkers, upgrade from a petrol guzzler to a nice new EV. And in the US, I think it will come in a Trump get me elected tax cut to the broad US voter base. So we're thinking in the portfolio about what shorts we should be covering given the sell-off that we have, and then how we should be positioning the long book for the inevitable policy responses. Fortunately, in our clusters, we already have, we've been obviously thinking over the very long term about what the outcomes are, the relative winners are, and many of our social commerce exposures are beneficiaries of what you describe as social distancing. The way you cope with coronavirus is you socially distance yourself. So food delivery, Uber, Alibaba, e-commerce, these are all tailwinds for these exposures. The incumbent software platforms, social distancing is what Office 365 allows you to do. Then in terms of the 5G wrapper or the green stimulus wrapper, ST Micro and Qualcomm, Samsung, they all are enablers of those major long-term trends. In the secular industrials, EV exposure, in the case of GE, aerospace exposure, which quite frankly may take some time to normalise. It's probably the most exposed industry. Fortunately, we have had some shorts that are paired against our GE exposure that have more than offset any weakness in GE. And then EDS Siemens, once again, a part of that decarbonisation, green energy thematic. Our pharma stocks are behaving as you would expect, quite defensively, and obviously with Biden having improved his chances in terms of leading the Democrats to the election, that takes a little bit of the tail risk around our drug stock exposures. Merck and Sanofi, two of our holdings, both have the world's leading vaccine businesses, and Western governments ultimately will treat coronavirus not so much through containment. It'll be quite different to what China has done, but they'll treat it ultimately through vaccination. The consumer incumbents, the strong retail banks, the more defensive elements of the incumbents, Coke and Pepsi, doing quite well. We are, in the banks, we will keep an eye on how this slowdown evolves, and if it starts to look like it's a much harder landing, we certainly won't be averse to risk controlling in our financials book. Tail risk protection has done a good job, and we will continue to look for ways to hedge the downside when those hedges are cheap to buy. So in summary, in terms of the Antipodes portfolio, what you are gaining exposure to is, from a pragmatic value approach, is stocks that on average in the long book, we would argue are cheap relative to their growth. So if they're low growth, then they have to be consequently on proportionately low multiples. If they're higher growth, then proportionately, we will pay a higher multiple for high growth. But on average, we're cheaper than the market. Our shorts are the opposite. Now, the great thing is we're getting our long book on a cheaper multiple than the market for higher growth than the market, and also a higher balance sheet quality. Whereas our shorts on higher multiples than the market, for lower growth than our long book, and for lower quality balance sheets, as you would expect. Back to you, Andrew.
Thanks, Jacob. And just to reiterate, the Antipodes portfolio has outperformed in 2020 year to date. in particular in the recent month of February, which saw heightened volatility and a strong drawdown in the market. Clearly 2019 was a difficult year, very strong up market, almost 30% rise in the ACWI index over that period, and our conservative positioning was a real headwind during that year. Though in 2018 and part year 2016, the portfolio also outperformed the index. The missing year is 2017, where we modestly underperformed. So I just wanted to put that all in context. Now let's turn to Q&A. If you have any questions for Jacob and me, please send them through now via the webinar interface. We've also received a number of queries prior to the call, and we'll do our best to answer each of them. As a preface to answering specific questions, I wanted to first summarise some of the feedback we received following a recent phone-based outreach campaign to our largest individual shareholders. While some shareholders expressed concern about performance relative to benchmark and/or the discount to NTA, significantly more told us they were long-term investors, that they understood the manager's investment approach has been at odds with the current market, and expected that the portfolio's lower net exposure, which has been a drag on relative performance during 2019 in particular, should be a benefit as and when the market turns. Indeed, we've seen this recently with the 4% outperformance during February. Now let's turn to some of the specific questions. In particular, we've been asked why the board has decided not to convert to an open-ended trust at this time. The reasons are threefold, primarily. First, the discount for APL is cyclical, not structural. What I mean by this is APL is a relatively young company, and the current NTA discount is a relatively recent phenomenon. For the first 2 years of APL's life, it traded around NTA. And the more recent discount in part reflects the widespread discounts across ASX-listed global equity LICs. In addition, the headwinds faced by the manager's strategy over the last year or so and the resulting underperformance relative to benchmark has not helped, clearly. However, over a full investment cycle, we're confident that existing and new shareholders will be attracted to the manager's ability to generate appealing risk-adjusted returns, in particular by protecting capital in periods of market drawdown, as we've seen recently. In addition, APL has scale, and it's not an orphan like other LICs that have considered the trust option, all of which were subscale with little market coverage. APL has in excess of 550 million of funds under management and over 8,500 shareholders. This enables the company to operate at a low operating cost per share, have high market liquidity. In fact, it's a top 15 most traded LIC on the ASX, and widespread research coverage from independent research houses such as Zenith and LIC brokers such as Bells, Wilsons and Value. Coupled with this is the current buyer's strike in active equities that's observable in both managed funds land and also in LICs. Active equity managed funds saw their worst year on record in 2019. In the LIC world, this manifests itself in NTA discounts. So the second primary reason is that the company structure and being listed has advantages for many investors. The LIC structure was the initial proposition put to IPO investors and provides shareholders with certain benefits not available in the trust structure or by being unlisted. APL is able to pay more consistent and regular franked dividends as a result of being a company structure than it could if it were a trust. We received feedback from numerous shareholders that the LIC structure is an attractive feature. And third, converting to a trust is complex and costly to implement. In one real-life example, the cost of converting to an unlisted trust reduced the NTA by approximately 6% and took around 6 months to implement, often to the frustration of shareholders who received multiple communications and had to action multiple instructions in order to effect the conversion. At the end of the day, the idea of converting to a trust is one suggestion for how to reduce the discount to NTA. Any decision taken by the board in relation to the NTA has to consider the interests of all shareholders. In our discussions with shareholders, many of whom are frustrated with the discount, as are we, most don't believe converting to a trust is appropriate for the reasons I've just mentioned. We have a very significant buyback in place with an expanded buyback to come. Of course, the board will continue to actively monitor all initiatives to address the discount to NTA and always welcomes shareholder feedback. The final point on this is that all directors, including me, the Managing Director of the Manager, and Alex Edenfeld, who is COO of Pinnacle, are very cognizant of our directors' duties to act in the best interests of the company and all shareholders. And be assured we will continue to do so, even when evaluating whatever decisions the board may make. Right, with that, let's turn to have a look at other questions that are coming through. And I've got one more investment related, so I'll direct this to you, Jacob. Where are you seeing the best opportunities to buy shares given the recent sell-off? So opportunities, I guess, in this environment.
Well, I think there's, as I mentioned on the call, there's probably three areas. I'll start with an area which we didn't really elaborate on, but with the collapse in the yields globally, and the US 10-year at 1%, the US probably has the mortgage market in the US is very sensitive to long-term rates, and obviously we've seen a big spike in refinance activity. And the US housing cycle is the one part of the US economy or household balance sheet we think where you can see the most natural demand. You haven't had this rigorous housing cycle, because it took a long time to recover from the global financial crisis. So we'd expect housing activity to act as a bit of a counterbalance to any other consumer slowdown. And so housing exposures, so quality housing exposures, certainly we're adding those into the portfolio as they're sold off, maintaining their weights and taking them up selectively. I think you can see some of the thematics around 5G continue to be the demand there will, I think, whilst it will have some sensitivity to consumer sentiment, governments will seek to accelerate the rollout of 5G as a way to offset weakness in their economies. So those sorts of the high quality exposures in that area, like Qualcomm, I think are great holdings and things that we've been adding to. And then finally, I think I think Europe, the EV cycle, the rebound in autos, I think will be led by the EV adoption. You can see what valuation investors are putting on Tesla. I wouldn't suggest you should. I think there's much. I wouldn't be piling into Tesla at this valuation, but I think there's much cheaper ways to gain those exposures. Companies with much more margin of safety. As I mentioned, ST Micro is an interesting way to play at the top of the food chain. A company that really supports provides the semiconductors that facilitate EV adoption. We don't believe that we think the policy responses will have to accelerate, and if they don't, there is significant downside, and that's where we will use our tail risk hedges to protect.
Thanks, Jacob. And interested shareholders can read more in the forthcoming monthly update and quarterly updates as usual. I'd also encourage shareholders, if you're interested in the topic of coronavirus and the impact on markets and how Antipodes is positioned, please look at the article that's available on the website. Now we're just about to tick over 30 minutes. We haven't got any other questions coming through. So with that, I'll draw the webinar to a close. I'll just remind you that the recording of the webinar will be available on our website from tomorrow. And from myself, from Jacob, Antipodes, the manager, and the board, I'd like to thank all shareholders for your support. Thanks and good morning.